So now we've got the government aggressively managing the yield curve by pushing down long-term yields, and we've got the balance sheet of the Fed still weighing on the bond market. And so I've come to the conclusion that the yield curve right now is meaningless. It just doesn't mean anything anymore. Inversion, uninversion, it's just not observing what it used to observe before 2008, which was the bond market's analysis of the economy. Now we have so much external interference in the bond market that the bond market is no longer doing what it's supposed to do. And so I think the yield curve is no longer a predictor. We've got the Sam's rule, and there's a similar issue there, I think, in that our unemployment data is now our employment data and unemployment data is now all screwed up. We've got over 6 million illegal immigrants that came into this country in 2022 and 2023, according to the Congressional Budget Office. And many of these people are working. They're in the labor force looking for work. They have jobs, and they're not captured in most of the data. So we've got all these peculiar issues that make it very difficult to use these once reliable indicators as a thermometer now for the economy. It's incredibly frustrating to see the data being so screwed up.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. The war of conflicting narratives continues. Bulls point to Q2's robust GDP growth, still relatively low unemployment, an upside surprise in July retail sales, and record high prices for both stocks and existing homes. Now, bears, on the other hand, warn about slowing Q3 estimated GDP growth, the triggering of the Sahm rule recession indicator, this week's massive downward revisions in payrolls, rising consumer debt delinquencies, and recent surveys reporting that half of American adults have less than $500 in savings. When sentiment is full of such crosscurrents, it's prudent to seek the counsel of those who take a cold and calculated look at the data to see what is versus what our biases may want us to see. Which is why we're fortunate to speak with macro analyst Wolf Richter of wolfstreet.com today. He'll share with us what the charts he regularly compiles are telling him about the true state of today's economy and markets. Wolf, thanks so much for joining us today.
Thanks for having me back.
Hey, Wolf, it's always a pleasure having you on the channel. Thanks for coming on, especially as things are beginning to get quite interesting here. Like I said in the intro, all the crosscurrents. This is when really looking at the data really helps us make a much more emotion-free assessment of what true reality is going on. I want to kick things off with you with the general question that I like to kick things off with. But real quick, folks, before I do, I was just, since this channel recently hit 100,000 subscribers, and thanks again to everybody who helped us hit that. One of the benefits we get from that is qualified for a YouTube consultant. So I get, once a month, I get about a half hour with somebody at YouTube, and they give me, ideas of things that we could be doing to make this channel even more successful. And one of the things that they mentioned today, because I had this month's consultation today, is they noticed that one that it's a minority of people watching the channel that have clicked the bell icon right next to the subscribe button. And when you do that, that's what notifies you when we have a new video out. And as you know, we put 4 videos out at least a week. And so if you want to be notified when they get sent out, please make sure you've clicked that bell icon. But the important thing they told me is even for the folks that have clicked it, in many cases, especially if you're usually watch these videos on a phone or some other device, that you oftentimes have to go into the settings for that device and tell your phone or your device, hey, yes, please let me get notified by YouTube when it wants to send me an alert. So even though you might have clicked the bell icon, you still might not be getting the alert if your settings aren't set up to receive alerts from YouTube. So they told me to just mention here on one of these videos make sure you've got that bell icon clicked, and even if you do, then go into your settings and make sure that you're set to get alerts from YouTube. All right, sorry about that piece of housekeeping, Wolf, but had to get that out there. Okay, so to the question that I love to start these conversations with you with, what's your current assessment of the global economy and financial markets?
Well, the global economy is doing reasonably well. And of course, there are big differences. And one of the standouts is that the U.S. economy has been surprisingly resilient among these high interest rates, and has continued to do pretty well despite all expectations of a recession for the past 2 years. Some other economies have slowed a lot more dramatically, especially in Europe and in Canada. We've seen that. So there's a little bit of a disconnect there, and in part because interest rates in the United States are not being transferred as quickly to the consumer as in other countries, because we have a 30-year fixed rate mortgage. That's our standard benchmark mortgage. And for current homeowners who got that mortgage a few years ago, nothing changes. Whereas in many other countries, they have variable rate mortgages that dominate, or fixed rate mortgages that are fixed for only a short period of time, so 2 years, 5 years, etc., and that then reset. So you get the transmission of higher interest rates to these households. So these are existing homeowners who are suddenly facing much higher payments and therefore have to cut back on their spending. And that's not happening in the United States. Consumers are, so existing homeowners are sort of spared this tragedy of high interest rates eating up their budget, and that is happening in Canada, and it's happening in other countries that are more focused on variable rate mortgages. And so this is one of the reasons why growth in the United States has been relatively strong. And this year it's been pretty good. It's been above average, above 10-year average in the United States over the past 6 months. And last year it was way above average. So generally, the 10-year average in the United States is for GDP growth to be around 2%. So far this year, we're above that. And last year, we're way above that. So that was surprising given the high interest rates. And it's still just plugging along at around about that level. In terms of the financial markets, they have been disconnected from the economy for many years. We've seen quantitative tightening since 2008. We've seen 0% interest rates for a long time during that period. And while the economy really hasn't grown in the United States to that extent, it grew at an average rate of 2%. Financial markets have exploded over that time period, and so now they're at very high and precarious levels. And I no longer connect financial markets to the economy. They're disconnected. They're financial markets are riding on other things, and so that's the situation we have. I think they're overpriced. I think they're overvalued. I think they're very precarious and very risky right now. And and that's unrelated to the economy. It's just the financial markets per se and the valuations that cause them to be this way.
Okay, so it sounds like you're saying markets, your data is flashing warning signs, precarious, overvalued. Economy, surprisingly green to date in terms of, hey, it's hung in there, it's done pretty well. As you look forward through your economic lens, do you expect that resilience to continue, or do you have more concerns for the economy looking ahead?
Yeah, so I've been surprised by that resilience, and I sort of expect to be surprised going forward. I've been expecting a recession. I've been looking for a recession. Not really expecting one, but looking for a recession for ever since the Fed started hiking by big steps in mid 2022. When we had 75 basis point rate hikes back then, back to back, and I thought, wow, this is going to hurt, and it didn't. And so I'm looking for signs that this is changing, and it's not changing. I don't see any data that's pointing at a recession. So a recession means not slower growth. A recession means negative growth, meaning declines in economic output, declines in jobs, yeah, deterioration in the job market, not in terms of slow growth, but in actual declines. And we just haven't seen that. I mean, I just don't see that at this point. I mean, it may come quickly at some point, but I just don't see that at this point.
Okay, so we've had a lot of people on this channel, just being transparent, a lot of experts on this channel, who argue that the U.S. is, either in pre-recessionary conditions on the way to a recession, or some who argue that the U.S. is already in recession, or at least sections of the economy are already in recession. And there certainly are a number of indicators out there that are at recessionary levels. Now, you're right. We still have positive GDP growth. So the kind of, standard finger to the wind, 2 quarters of negative GDP growth. We haven't seen anything close to that in recent times. So what I'm saying, Wolf, is I'm going to probe with you for a little bit to try to, get you to highlight some of the data series that you would expect to be giving you recessionary readings that aren't, to help the viewers understand, exactly what you're saying by saying, hey, I'm just not seeing this thing here yet. And we've talked enough where I know that you're not philosophically wed to a no landing or soft landing scenario. Like you said, you're kind of looking out there for things that might show that we're in a hard landing scenario, but it sounds like from the data sets that you monitor most closely, you're just not seeing that, at least not yet.
Yeah, that's correct. And uh, yeah, we've been hearing about a recession, an impending recession, of being already in a recession for quite a while now. And one of the reasons is that we have some indicators that in the past have strongly suggested we're in a recession or close to a recession. And one of them is the inverted yield curve. And so the yield curve has been inverted for like 2 years, and we still don't have a recession. So that makes you wonder uh, what the yield curve actually tells you. And yield curve inversion means that the long-term treasury yields are lower than the short-term treasury yields, such as the 10 years being lower than the 2-year, or the 10-year yield being lower than the 3-month yield. And that's what we've had really since the Fed started hiking. And what happened is, when the Fed started hiking so fast, it pushed up the short-term yields, and the long-term yields came up, but eventually stopped coming up, and kind of stayed the same. And then we had rate cut mania, and they fell, whereas the short-term rates remained at the level that is bookmarked by the Fed's policy rates. So yeah, we've had a failure of the yield curve prediction before, and it falsely predicted a recession in 2019 when it briefly inverted and then uninverted, and we didn't get a recession. What we got in 2020 was a pandemic and a lockdown, and the yield curve does not predict that. It predicts a business cycle recession, so the standard business cycle recession, and we didn't get that. And so that made me wonder. Now, this is the second time in a row. And that made me wonder, when central banks are loading up the balance sheet like this, that the long-term yields are pushed down. Even if central banks are doing QT like they're doing now, the long-term yields continue to be pushed down by the weight of the balance sheet. And so these long-term yields cannot go up. And then now we've got the Treasury Department helping to push down long-term yields by issuing more T-bills, shorter-term bonds, securities, and issuing fewer long-term securities. So that's taking some of the pressure off on the longer-term yields, and it's also buying back some of the older Treasury securities. So replacing them with new ones. So that's not QE; it's just an exchange of securities, but it's pushing down yields in the long term. So now we've got the government aggressively managing the yield curve by pushing down long-term yields, and we've got the balance sheet of the Fed still weighing on the bond market. And so I've come to the conclusion that the yield curve right now is meaningless. It just doesn't mean anything anymore. Inversion, uninversion, it's just not observing what it used to observe before 2008, which was the bond market's analysis of the economy. Now we have so much external interference in the bond market that the bond market is no longer doing what it's supposed to do. And so I think the yield curve is no longer a predictor. We've got the Sam's rule, and there's a similar issue there, I think, in that our unemployment data is now our employment data and unemployment data is now all screwed up. We've got over 6 million illegal immigrants that came into this country in 2022 and 2023, according to the Congressional Budget Office. And many of these people are working. They're in the labor force looking for work. They have jobs, and they're not captured in most of the data. So like the revision we got yesterday, it didn't include any of the illegal immigrants. It was based on unemployment insurance tax filings. So so we've got a lot more people working than we have an ability to track. So and I've said this for months. Our unemployment data is completely screwed up because we're underestimating the number of people who are working, because many of them, the new arrivals, they're illegal, and they're not being captured by the data. So so we've got all these peculiar issues that make it very difficult to use these once reliable indicators as a thermometer now for the economy, and so we have to look at other stuff. The labor market data it's just, I mean, it's incredibly frustrating to see the data being so screwed up. And it's, I mentioned some of it. It's illegal immigrants that have shown up that are being captured by the data, and it's other issues. And it's the Census Bureau using the algos from before the pandemic to adjust its population. And now we've had this wave of people coming in, and the algos don't work anymore. So we've got very unreliable data, and we've had a huge surge in the labor force due to these illegal immigrants. We've got fairly strong hiring. We've got historically low unemployment claims, and we're below what we were a year ago with initial unemployment claims. And so that's one of my indicators. One of my strongest recession indicators is I want to see the initial unemployment claims and continued unemployment claims to go up substantially, and they need to go up substantially before there's a recession. And we just haven't seen that. So all the things that we're trained to look at have failed so far, and so we'll get frustrated, but the economy is plugging along, and that's what we're seeing.
All right, kind of things I want to pull out in there. One small one, just because I'm not entirely sure what you meant by it. Totally get when you talked about how the Treasury is helping keep long-term yields down, long-term Treasury yields down. But you talked about just the weight of the Fed balance sheet depresses yields on the long end of the curve. Can you just explain why?
Yeah, so the Fed's balance sheet still has close to $4 trillion in Treasury securities on it, and that's down a lot. It's gotten rid of a lot because of QT, so that's helped some, but it's still a huge player in the market, and it gets rid of Treasury securities by allowing them to mature, and it gets face value when they mature, and then not replace them. And now, there's a limit on that. Before June, the limit was $65 billion a month. So the Fed would allow $65 billion a month of Treasury securities to mature and roll off without a replacement. And then any leftover that matured above that $65 billion, it it replaced. It bought some more. It went to the auction, bought some more. Those numbers were pretty small, and many months there weren't any replacements. And so now we've got this new pace of QT, which is $25 billion a month in Treasury security roll-off. And there is now quite a bit more maturing than 25 billion. So the excess of 25 billion, the Fed replaces with new Treasury securities. So it's still in the market. It's still weighing on the bond market in that sense. So it's a gigantic holder, and it's still there. And in that sense, I think, and then there's a psychological aspect of it too. As soon as rates go up, people expect the Fed to step in and push them back down. So in the future, I mean, we've had that issue. So as long as the Fed has a balance sheet like that, I think there's some weight on yields, downward pressure on yields, and uh, even though it does QT, the pace is now slower than it was, and yields have come down since the pace has slowed, and the Treasury Department simultaneously, these are two things that happen simultaneously. The Treasury Department started buying back Treasury securities, longer-term Treasury securities. It happened a month ago, and so now it's doing that, and it's issuing new securities and using those funds to buy older off-the-run Treasury securities, and the purpose obviously is for the Treasury Department to keep long-term interest rates low or lower. And from a taxpayer point of view, that makes sense, because it reduces the interest expense, and so the Treasury Department is sort of doing its job. It's aggressively managing the market to lower the interest expense that the United States has to pay. Well, that means that yields are lower than they would be otherwise, and so that helps invert the yield curve, because you're pushing down long-term yields, and short-term yields are bracketed by the Fed's policy rate. So you've got that. In that sense, I was talking about the yield curve. That's one of the reasons why the yield curve is still inverted. Because we've got all this weight on the longer-term yields.
Okay, thank you. That explanation makes total sense to me, and I totally understood the Treasury part. And now that you explained it, I totally get the Fed part, which is the Fed is actively buying more Treasuries now that it reduced its QE, let's just let these things fully mature limit from 65 billion a month to 25 billion a month. And I remember when they announced that. So it's funny because people think, okay, QT, Fed isn't buying any more Treasuries. They are. They're letting the cap fully mature, and then they have to go out, and whatever's up for maturity above and beyond that, they have to go and buy and replace that. So that makes total sense. Okay. Moving on to the jobs data. So, I mean, there's kind of a meta question here, Wolf, which is, you're an incredibly data-driven guy, and you're highly known and respected for the many charts that you publish on a regular basis. The meta question is kind of like, how much faith can we have in that data these days when so much dust is in the air? And certainly in the employment data, I mean, this has been an ongoing debate for, ever since I founded Thoughtful Money, for sure. But even the years before that, I was talking about it. But certainly, kind of post-COVID, the employment data has just made less and less sense as time has gone on here. And these dramatic revisions that we just saw this week are big validation of that, right? And I do want to get into a moment for the repercussions of the revisions, in the sense that policy and market trading and whatever have happened off of the overinflated numbers. So now that the world is having a little bit more of a truer sense of what things might be, what are the implications of that? But we'll get to that topic in a minute. You mentioned that the jobs data doesn't take into effect the mass wave of illegal immigrants that we've had in this country. And I believe that is true to a material extent. How much, we don't know. Nobody's tracking this data, right? One thing I do want to say, though, is I wrestle with how much weight to give that. because jobs aren't completely fungible, right? The loss of a white collar or a high skill blue collar job isn't the same as the type of job that most of the illegal immigrants are competing for right now. And so it's not necessarily a one-to-one equality of there. I also think too, if indeed that is going on, where the picture would look worse if we didn't have the wave of illegal immigrants coming in because they're keeping the total jobs number higher. Um, you know, if there's displacement going on with sort of U.S. citizens from folks that are here illegally looking for work, if there's sort of a displacement of jobs from one party to the other, is that a net, is that a net good for society? I'm not sure it is. So even though we can say, yeah, the jobs numbers aren't coming down as much, in terms of sort of the lived reality for America, Americans as a whole, is that still diminishing in that scenario? So I know it's a very sticky issue how to wrestle with the illegal immigrant situation, just because we're flying blind for the most part.
So let me just throw in here a couple of things. The job numbers are not coming down. So even after the revision that we got yesterday, the job growth was still over 2 million over the 12-month period. And that was just right in the pre-pandemic average, 2018, 2019. So what it did show is that the job growth was less hot than previously shown. So, but it was right there in the good times average.
Okay.
And
And I just want to make one qualifier. I'm not disputing that at all. But for the year of 2023, pre-adjustments, I think it was an average increase in payrolls of 230,000 a month. Post adjustments, 130,000 a month. So it is quite a material difference in terms of the health of what we thought the market was. I think what you're saying is it's still a good market, but it wasn't the raging good times that we were all being told.
yeah, so the average per month came down to 175,000. And as I mentioned, in 2018, 2019, the average was 173,000. So just a little lower than what it was during that 12-month period recently. But the main thing I wanted to throw in there, rather than haggling over numbers, is your point about a job shifting from Americans who have been here to new immigrants. And that's actually what we've not yet seen, because we didn't see the unemployment claims come up. And so illegal immigrants cannot file for unemployment. So if they lose a job, they're just on their own. And so they don't show up in the unemployment claims data, unemployment insurance data. They show up maybe in some of the in the survey data, but they're not showing up in the unemployment insurance data that companies are filing and that the laid off people are filing. So we really haven't seen that shift yet. But what we have seen is that the upward pressure in wages that we saw during the pandemic at the lower levels of the job spectrum has gone away. So
Right.
the biggest wage gains were made at the lower end of the service industries, like in hotels and restaurants and those kind of service jobs, that cleaning, that don't pay all that much. They've had the biggest wage gains during the pandemic because there was a shortage of workers, and companies lost a lot of their staff, and they had to pay out of their nose to attract them. And people changed jobs, went from one hotel to another,
Right. And we
and
had revenge travel, just increasing
yeah,
demand. Yeah.
and that's gone away. So in part because there was the surge of immigrants that are more than willing to take those jobs wherever they get paid. And so that big increase in wages that we have seen at the bottom end of the wage scale, that has gone. So there's still wage increases, but they have more or less normalized. They may be still higher than normal, but they're not like they used to be. And so we did see the Fed's been talking about that impact of the immigrants into the labor market, that it's moderating wage gains, and we've seen that. So we know they're here. We know they're putting downward pressure on salaries. What we haven't seen is that people are actually losing their job to an immigrant. That really hasn't shown up in the numbers. And I mean, it might occasionally happen, but I mean, youth unemployment is one of the things to watch. And so this is a big issue in Canada, where they had even bigger waves of immigrants, and their youth unemployment has spiked because young people, when they first enter the workforce, that's exactly the kind of jobs that they will try to get, that they compete with immigrants with. And so that happens in other countries, and we see that, and I really haven't seen much of that in the United States, and that's something to watch. And if that happens, it's not a good thing, like you said. That's a shift, and I think that immigration itself is a huge problem. And that massive unexpected wave of immigrants, nobody's ready for that. It's just chaotic, and it's terrible, and it should have never happened, but it does have that impact on the labor market, that suddenly the wage pressures went away, and at the lower levels, we've got plenty of people now applying for those jobs, and and job growth in part has continued because now the people that are willing to do those jobs.
So let me ask you another question here, that something that might be getting impacted by this wave of immigrants as well is retail sales. So I'll let you talk about anything you want to about the July numbers that came out that were a big beat on a monthly basis, but I believe a big part of that monthly beat was the fact that the prior month had actually been revised down pretty dramatically. So who knows whether on an absolute level it was that really much of a beat, at least on an average level. But where I'm going with this is retail sales have been pretty anemic, right? Growth in retail sales have been pretty anemic of late. I'm not even sure if they're positive on a real basis, if you inflation adjust them.
So retailers sell goods. They don't sell services, they sell goods. They sell vehicles or motor vehicles. That's the number one category. And then we have e-commerce, goods sales. So that's everything. And then you have other things like groceries and gasoline and some of those big ones, and general merchandise retailers such as Walmart that sell everything. So the retail sales is company data. It's not consumer data, it's company data. It's what companies report, what retailers reported as selling. And they're very volatile, and that's why I like to look at 3-month averages, and they remove the revisions. So
Noise.
I include all the revisions, and when you have one down month, one up month, it averages out, and so the 3 months average has been pretty good, and but we also see that prices of goods have plunged. So used car prices have given up half of the pandemic spike. Durable goods prices have declined, have dropped by the biggest amount in over 20 years, and gasoline prices are way down. So a whole lot of categories of goods are now selling at lower prices. So when you try to look for real retail sales, you have to adjust for the price changes in goods. You can't adjust for the price changes in rents and other services. So that's why when the Bureau of Economic Analysis, when it does its real consumer spending series and by category, it's using the price index for each category to adjust the category to inflation. So you can't use the overall inflation numbers to adjust retail categories. They don't apply. There's 30%, a third of CPI is housing costs. They don't apply to goods that retailers sell, to cars. So you have to look at the CPI for used vehicles, and that's way down. It plunged. And you have to look at the CPI for new vehicles, and that came down. You have to look at the CPI for food, and that's still rising. That exploded during the pandemic, and it sort of plateaued and is rising at very slow levels, but it's still rising a little bit. You have to look at the CPI for gasoline, and that plunged. Appliances, electronics, all these things have come down in price. So these are negative CPI readings we get on these categories. And I talk about that in my CPI articles. And there's a bunch of charts, where the CPI just goes way down. It's not percent change, it's at the price levels, So, durable goods have been deflating and for close to 2 years. And
this isn't
so,
my question, but I'm just curious, how much of that deflation do you think is due to supply recovery, right, with fixing the supply chains versus softening demand?
well, I think part of that deflation is the necessary after effect of the price spikes that we have. So during, let's use used vehicles. During the pandemic, during the time period between 2021 and mid 2022, during that fairly short time period, used vehicle prices spiked by close to 60%. But it's completely insane, and that's not sustainable. So this was a mania type. Now, used vehicles are for many people a discretionary item. They still can drive what they have for another year or two. And new vehicles, the same thing. Most people, unless they total their vehicle, they can drive what they have for a little while longer. And so they went out. They had a lot of money. They had free money from the government and for down payment, and the interest rates were low. And they went out and they splurged and they said, "To heck with those big prices. We don't care. We're going to buy." And dealers played along with it. Everybody jacked up the prices, and that's not sustainable. And then we had the shortages that with semiconductors that caused new vehicle shortages, and so this kind of created this extraordinary historic price spike. And what we're seeing now is coming off that spike. That's natural. That has to happen. That was predicted. It's unsustainable to have that kind of price spike in durable goods. So durable goods are still way higher than they used to be before the pandemic, but they've given up a big chunk of that price spike. So demand's still there. In 2024 so far, auto sales are the highest since 2019. And we see that in other categories as well. The demand is still pretty good. What's there now in large numbers is supply. So we're sitting on a huge pile of overpriced new trucks, and especially Ram and some of the other manufacturers. They started getting greedy and building those $100,000 trucks, and people are buying more reasonably priced vehicles now, and the automakers are refusing to cut the prices, so those vehicles are sitting. And so we've seen the supply come online. We've seen the supply in electronics was constrained during the pandemic, and it's coming back, or has come back. I mean, it's everything. Essentially, everything that you want to buy is out there now. You can buy, and so there is all the supply we want, and demand's pretty good, but the prices are way too high to be sustainable, and consumers become critical, and they're not really wanting to play along. And we've seen that during the pandemic, consumers gave up checking prices. They kind of just paid whatever, and we're now kind of back to normal, where people are actually looking at prices and they're worrying when something. I mean, so that's not durable good. That's insurance, car insurance. I just got my Geico bill and it went up another 17%. So I mean, inflation is there in services. It's not in durable goods anymore. Goods prices have come way down, and so that's not a result of demand. That's a result of supply and of unsustainable prices during the pandemic, and we see that in sales. And sales are pretty good, and I mean, Walmart had a very good quarter. Some of the other retailers did too. Walmart did the right thing. They're cutting some prices. They're rolling back some of those price increases, and that's what we need to do after these ridiculous price spikes. And it's good for consumers. That's really what needs to happen. We need to make those prices not permanent, but they need to come down.
Okay. Again, you keep opening the doors on tons of different questions. I'm gonna try to keep my through line here. So the question I was trying to get to is, let's say there's been, over the past, since COVID, 10 million undocumented folks coming into the country, right? Just to pick a round number. They do buy goods and services, right? They have to buy groceries, right? Maybe don't buy cars at the same rate or at the same price level as the average American, but they need cars to get around and things like that. And I'm going to ask you just some mental math here, because I don't think anyone charts this actively. We just don't have the data. But if we look at retail sales, could retail sales per capita be falling off here if we have a bigger true denominator than the data that the government uses, because we should really be sort of tacking 10 million extra people into this thing.
Yeah. Well, I would hope it would, because we went on this durable goods buying binge during the pandemic, and I hope that I would think that on a per capita basis, people have the garages full of stuff and the attics full of stuff, and it's time to not. And we've seen some of that. People, they bought all the sporting goods they ever need during the pandemic, and now they're back to traveling. They're back to flying all over the world and spending money on services and going to shows and football games and and theaters and so forth. So we've seen the shift from goods. I would expect that on a per capita basis that people spend less money on goods because they're spending more money on services. They're doing more stuff, and so yeah, that's for the overall economy though. That doesn't matter. So that's the thing to point out, per capita. I mean, that's interesting to look at, but for the overall economy, for GDP growth, for consumer spending growth, per capita doesn't matter. What
Right.
matters is overall
A
spending.
dollar's a
So
dollar. Yeah. How many
yeah,
dollars are getting spent? So let's continue to tug at this a little bit though. So, listening to you, it's easy to take away kind of a vibe of like, yeah, the consumer's doing okay. The consumer's hanging in there, which may be true. So, I'm totally open to that. I will say that there's lots of data I look at, whether it's, consumer household debt balances and how dramatically they've been increasing, whether it's the delinquencies that we're starting to see in consumer credit card debt and auto loans, and maybe even now just we're starting to see that maybe in mortgages too. I talked about at the beginning in the intro here, a recent survey by a firm that reports that 3 out of 5, actually, I mentioned a different survey that said half of Americans don't have $500. They've got $500 or less in savings. But the survey by a firm said that 3 out of 5 American adults say, I don't care what the official numbers say, I personally feel like I'm in a recession. Right. So I talk on this channel about the importance of understanding the difference between the mean versus the median here, where I'm pretty open to the idea that for the past couple of years, the majority of consumer spending, or if not the majority, a large part of it, has been driven by the top 20%. Right? These are the folks that are travel happy and spending like crazy on services, and these are the ones still buying houses in this frozen housing market, stuff like that. I guess 2 questions for you. One, do you feel like that's largely the case, where what's really powering consumer spending right now are the top well-off households, even if the bottom 80% are maybe increasingly struggling? And if true, do you expect that to continue, or at some point, do we start to see weakness in that top cohort as well?
when you always have the big spenders. I mean, that's the people that have lots of money spend lots of money. I mean, that's how it is. And a homeless person can't spend anything. I mean, and poor people can spend only very little. And so that's always the case. But the lower end of the income spectrum has gotten the biggest wage increases in the last few years, and they're
But
spending every
also
dime.
they've had the biggest cost of living. Oh, sorry.
Yeah.
They've had maybe the biggest relative increases of the other cohorts in wages, but I'm not sure in every case it's kept up with the cost of living increase.
Yeah. So, but the thing is, they have had big. So we're talking about the economy. We got when we talk about the economy, we got to get away from the social consciousness of, oh,
Yep.
those poor people don't have anything to spend.
Yep.
So we got to look at actually what makes this economy move, and so at the lower income spectrum, these people have gotten very big pay increases, the biggest in decades, and they're spending every dime of this additional money because they don't have a lot of money. Yeah, so they get a 10% wage increase and they're going to spend that, and so the spending goes up 10%, and and that's a fairly good size of the population. So I'm looking at maybe the bottom 25% that falls into on the income spectrum that falls into that category, and they don't make a lot of money. They're not big spenders, but they got big increases, and they spend every dime of it because they don't make enough to save, and so they're we've seen that. We've seen you look at the cash balances that consumers have. And so, I mean, these surveys about half of the consumers don't have $500 in the savings account. I mean, most people don't even have a savings account. You don't need a savings account. You get your 401k and you got your credit cards that you pay off every month, but you run your payments through that, and you got a checking account, and you got your investments. And I mean, who's got a savings account? Used to pay nothing. Now we get some money on our savings, but people buy T-bills. So there's trillions of dollars of T-bills outstanding. There's $6 trillion in money market funds. CDs are like $3 trillion in CDs. There's stocks and bonds people have, and 65% of the households own their own home. So you've got the home equity there that has boomed. So already, this notion that 20% of the only 20% of the population have anything is wrong, because we got 65% of the households that are homeowners, and they've benefited from the surge in house prices in recent years. And among the renters, 35% of renters of the households, we have the renters of choice. So these are high income renters, and everything in the last 10 years that has been built in terms of rentals has been for these renters of choice. So these are single family houses that have been built brand new for renters, and so built to rent. It's a huge thing in real estate right now. We've had all the big apartment towers. Every single one of them is for renters of choice with expensive apartments. And so this is the American population. I mean, it's a big part is doing really well, and then there is a part that's not doing well, that's really struggling. And that part that's struggling obviously got hit the most by inflation, because the food inflation was enormous and rent inflation was big, and that's where most of the money goes. And so they've gotten hit really hard, but that's maybe 25-30% of the population. And so, that's the people are out there saying, well, Americans are poor, they don't have anything. But that's why they never understand that the economy keeps growing, because it's wrong. Americans have lots of stuff. The majority of Americans, a vast majority of Americans, are doing pretty well. And we have a huge problem in wealth disparity. That's a gigantic problem. It's a social problem, and it should be addressed. We have all kinds of other problems, but this idea that most Americans don't have anything is wrong. And people who adhere to this idea are constantly surprised that the economy is doing well, and they come up with some theories why somehow the economy should be already in a depression, because everybody is poor and lives out of a box or something, and it doesn't have anything. And I mean, the fundamental principle in understanding the economy is to understand the wealth of the American households, and the income levels of American households. I mean, it's big, and yeah, there are huge disparities, but it's still at the bottom 25% excluded. There's a lot of wealth spread across these layers, and they're spending money, and we're seeing it. We're seeing this. They're buying expensive cars. They're buying expensive used cars. They're buying expensive flights. We're going to have a record Labor Day travel season. Airports, are going to be chaos, and it's just that kind of stuff all over again. And we see that in the data. We see it anecdotally. There's a lot of money flowing around, and it gets spent.
So you put your finger on where I was trying to go with this. And again, I don't disagree at all that there's a lot of money flowing around and that there's a lot of assets out there. I think there is an argument, there is an argument that it's not evenly owned. And you've even said, we got a big wealth divide in this country, right? But you said here, the vast majority of American households are doing very well. And that, I think, is the difference that I'm hearing between you and a lot of other experts that I'm talking to on this channel, where, a stat you hear often is 93% of all financial assets are owned by the top 10% of households, right? So, you know,
Wait a minute. 65% of the households are homeowners, and home prices have surged 50% in the last few years. You know, you cannot ignore those kinds of things. Yeah,
yeah, no,
that's yeah.
and so I agree.
I mean, sure, you've got the Warren Buffetts and the Elon Musk that own many billions of dollars, and that's where the wealth disparity comes from. But then you've got the big layer in the middle that own their homes and they have a 401k, and they have savings, and they have CDs and money market funds, and they have cars, and they've got all that stuff.
Well, and that's what I'm talking about, because what you hear about a lot, where I think a lot of I'm going to put myself in the mind of a lot of viewers here, is you hear a lot that the middle class is getting squeezed out, and so that's kind of who I'm not talking about. The bottom 25%, there will always be a bottom 25%, right? It's the middle class. It's the engine of kind of mass prosperity in America and in the West. I think a lot of people feel like that is under siege here. But again, and I'm not trying to push an agenda. I'm trying to clarify your stance. It sounds like you're saying, middle class is actually hanging in there.
Yeah, that's what it looks like to me. They've got money, they make money, they're spending money. I mean, I'm furious about the wealth disparity in this country. And it's a scandal. It's terrible. But the middle class still has and lots of resources, lots of money. They've got home equity. Yeah, they've got 401ks wherever they work. They've got other assets. I just can't not see that. I
Okay.
just there.
Okay. So we're talking about the snapshot. Let's look forward on a couple of things. So first off, what's your outlook on inflation here? And I want to give you kudos that you've been pretty accurate in the times I've had you on this channel, and we've talked about your inflation outlook. You were one of the very first, experts that I saw who was really noting, this was, I don't know, a year plus ago, the change of that, hey, the real inflation is now not going to be goods anymore. It's going to be in services, and that's really where it's been hanging out. I guess now it's in housing. That's the stickiest part of it here at this point. But as you look forward, do you expect disinflation to continue? Do you think the Fed's going to hit its 2% target in a relatively, near amount of time, or do you think it's going to be higher for whatever reason?
Well, inflation forecasting is sort of a fool's errand because inflation has its own mind, and I can see a few dynamics. So the price plunges that we've seen, relatively speaking, in durable goods, that's going to end someday. And the biggest component of that, of the drop, the most dramatic drop was in used vehicles, and already we're seeing a firming of prices there. And so on the wholesale side, we saw last month. On the CPI side, not seasonally adjusted, used vehicle prices really haven't changed in a few months. They are seasonally adjusted, they continue to drop. But now we see reporting from dealers that prices are firming on the retail side. So the CPI is going to reflect that at some point. So I think the heavy lifting that was done by used vehicles coming down, that's going to end. And now new vehicle prices, so we're talking about the big components of durable goods here. So these are the big items. And on the new vehicle side, prices need to come down more, but they're incredibly sticky because your automakers and dealers trying to protect the profit margins, and so they've been very reluctant to bring down the new vehicle prices. Their inventories are going to force them to, but and EV makers, Tesla has already kind of messed up their game, but they're very reluctant to do that. So we'll have to see. Now, in terms of services. And I just mentioned my car insurance, and one of the big components of services beyond housing is insurance and different kinds of insurance. And car insurance has been rising at around 20% year over year, and it continues to do that. And we've seen other things like that, little services, like my little company, the Wall Street media mogul Empire, is paying a company to back up daily the server on an offsite facility, and they doubled my annual rate for that.
Mm-hmm.
And there's little stuff like that. Your streaming is getting more expensive. Stuff that was free suddenly they get extracted from the package, and you have to pay for it separately. And in services, I, I just don't see. So inflation has come down a lot in services too from where it was, but I don't. It doesn't need to go back to 2%, and it's never really been 2%. It's always been higher because durable goods inflation is normally lower, and so you can have services inflation at 3% and durable goods inflation very low, and you come close to the Fed's target. But for services to reach 3%, I think that's going to be very tough because housing, I don't see housing inflation to go down that low. I've already seen last month in CPI, and last month in CPI, so July CPI was a bad surprise. We had services inflation jump up, and including rents. And so that's a month-to-month basis. And of course, 1 month doesn't make a trend, so we need to see confirmation. Uh, so I think we will have surprises in inflation. We'll have nasty surprises. I've said that for 2 years. Inflation dishes up nasty surprises. I'm glad that inflation has come down as much as it has. It has come down a bunch. But in terms of going back to 2% overall to the Fed's target, I think this is going to be very tough. And I think we'll also may look at an acceleration of inflation uh, in terms of the numbers going forward. And it's still going to be much lower than it was. But I think it's going to be very tough to get to that 2%. And especially if the Fed starts cutting rates, I think this is going to provide a little bit more fuel for inflation to to do its thing. And so I'm not forecasting inflation. I'm just looking at the different components that we have and what they're doing. And I think I'm going to expect a nasty surprise. Yeah, that's just what we've been getting. And so I think that's what we continue to get. We're going to get nasty surprises.
To the upside.
And inflation upside, yeah.
Okay.
And,
All right.
and surprise to the downside is not nasty. That's most welcome.
Right. So you mentioned if the Fed starts cutting, of course, market absolutely thinks the Fed's going to cut in September. The debate is whether it's going to cut 25 or 50 basis points. What's your general outlook for policy, both monetary and fiscal going forward? And in your answer, if you can just address this, looking through your lens, which is economy surprisingly resilient, the consumer, the middle class, surprisingly resilient, doing just fine. Markets, financial markets at all-time highs, existing home prices at all-time highs. Should the Fed be cutting here? I mean, these aren't easing conditions.
Yeah. Yeah. So we have one sector in the economy that's in a total utter depression, and that's commercial real estate. And prices have collapsed. Uh, we've had huge foreclosures on office towers, apartment buildings, billions of dollars collection of apartment buildings. High interest rates have beaten the bejesus out of commercial real estate. And in a way, that's good because let me talk a little bit about leverage in real estate. When a company, in the olden days, a company might buy an office building for its own purposes, and then 30 years, let's say it writes it off, or it writes down the cost of the building, not the land, but it'll depreciate the cost of the building to zero over 39 years. And then when it sells the building at a very low price, maybe the building being worthless and the land being valuable. So we've seen that, you sell the property for land value in the office sector. That's now kind of common. These office towers sell essentially for land value. And when you used to, in the olden days, you still made a profit on paper because you depreciated the building to zero. So you recapture maybe a little bit or maybe nothing of that. And so, but you've already expensed that. So that's gone. That's not a loss. And then you make a gain on the sale of the land. And so now we've got a financialized system where everything is financialized. and everybody refinanced those buildings, cash out refinanced those buildings in 2015, 16, 17, 18, 19, 20, and at huge valuations. And now we've got
You got great big loans
loan.
against those
Yeah, so
properties.
we've got a $500 million loan on a building that's worth $100 million land value. And so now we've got lenders that are losing $400 million on this building because they were stupid enough to accept it as collateral a few years ago. And so now, yeah, high interest rates would have prevented this kind of situation from building up like this. There's $5 trillion in commercial real estate debt out there, and a lot of it is in those precarious levels. And thankfully, it's not banks that are mostly on the hook for it, but investors. And so that segment is in the depression. But what I see now is they're cleaning up. The high interest rates are helping, are forcing the sector to clean up and bring the valuations down, be realistic, write off the stuff, uh, allow developers to come in with a lower cost base and do something new. And so that's why I don't really feel like we should stop this, because commercial real estate needs to be cleaned up, and they're doing it. And we're going to see redevelopment of office towers and those kinds of things that were bought for cents on the dollar, and that's great. And conversion, tearing them down and putting up apartment buildings or condo buildings, or converting them or doing something else. And so in terms of the rest of the economy, I don't think the Fed should cut or shouldn't cut a lot. I mean, their interest rates are pretty high. So given where inflation is now, interest rates are at the bracketed between 5.25% and 5.5%. And that's pretty high given that inflation is quite a bit lower than that. So, I mean, the Fed could cut once or twice and still be okay if inflation doesn't move a lot. And yeah, there's no reason at all to cut a lot more than that. I mean, people talk about cutting to 4% or 3.5% or 3%. I think that's ridiculous. The Fed doesn't need to do that. And it looks like that the Fed is not interested in doing that. I mean, that's market hope, and the market is almost always wrong about forecasting federal funds rate. I mean, I've got these beautiful charts and about that, and so they never get that right. But yeah, so the Fed can cut. It can cut a little bit, and I don't think will damage anything. And the economy so far is doing pretty good. And we've got that one sector that would need lower interest rates, but it really needs to be cleaned up, and high interest rates will force it to clean up. So I think we're in a pretty good place there. Um, yeah, you mentioned fiscal policy, and that's one of the fiascos we have. We have two fiascos in this country, and one is fiscal policy. And of course, that is in part why the economy has been so resilient, because the government is running these huge deficits, and $2 to $3 trillion a year in a growing economy, not a recession. And that's stimulative. And so, but that's unsustainable. It's crazy, and it's a huge problem, and it needs to be addressed. And of course, nobody's even in Congress is even seriously thinking about it. And then we have our second fiasco, and that's the over leverage in the corporate sector. And that's really where leverage has gone. It's no longer the consumer. The consumer cleaned up. When you look at the leverage metrics that I have, debt to disposable income, that's one of the big metrics that we have. They're lower than they've been in decades. So it's consumers are not over leveraged, but companies and the government is, and I think that could provide for a lot of issues in different ways. And obviously, the fiscal issue is different from the corporate issue. The corporate issue could lead to all kinds of economic problems, and that's those are the top two items on my worry list.
All right, so I was going to get there. Part of my arc here was getting you to this last point, because I saw in a recent interview you gave, you were asked what keeps you up at night, and your answer was this over financialization of the system that was then set into hyperdrive with too much leverage. So one might have listened to this part of the interview, Wolf, and said, Wolf seems relatively kind of bullish on where things are going, right? And maybe that is true in the immediate term, but it sounds like long term, you have very serious concerns about a reckoning that's going to mathematically have to happen at some point. You're nodding a little bit as I'm saying this, but feel free to correct this in any way. My question for you, though, Wolf, is if what you fear will happen does indeed take place, what does that look like?
So in terms of the fiscal situation, the solution always to this kind of mess is inflation.
Yep.
And
Which destroys the purchasing power of your dollar. Yeah.
yeah, and destroys the purchasing power of outstanding debt. And and that's one of the contributors, I believe, to my notion that inflation will not go away. Yeah, we'll have that. And hopefully it will be moderate inflation, not something that goes completely haywire. And I think the Fed is competent enough uh, to I've called it the most reckless Fed ever back in 2021, I believe, or 22, when inflation started soaring and the Fed was still doing QE and 0% interest rates.
200
But
billion a month. Yeah.
yeah. And so that was, you can Google that, the most reckless Fed ever, and then my articles come up. But they have changed. So now they've become one of the most hawkish central banks out there. They've raised the rates the most among the developed economies, and they've kept them there the longest. They still haven't cut, and and they're still doing QT, and so I think there is now a willingness to actually crack down on inflation if it gets bad again. And but not crack down all the way. This is the thing. They understand too that the solution to the fiscal mess is inflation. You got to have some inflation to solve that. So maybe 4%, 5% inflation, but not 10 or 15 or 50%. So I think that's kind of the unspoken consensus that if the government doesn't straighten out the fiscal mess, if some middle ground inflation will occur that makes that amount of debt more manageable. And a country that issues its own currency cannot really default in the classic sense of not being able to pay its debts, because you can always print more money to pay it. But it can default in the backward sense, in that inflation just devalues the debt.
Right. Well, it devalues the currency. It's a currency default. Yeah.
Yeah, and so you have everybody gets the money back, but the money is worth less, so that's the impact of inflation. And that's the scenario I think we're steering into with these kinds of fiscal policies we've had and continue to have. I mean, there's nobody in Congress right now that's serious. I mean, there's some grandstanding, but there's nobody really serious about cutting the budget and increasing taxes. You got to do. I mean, we've got such a huge deficit. You got to do both. You got to cut the budget, and you got to increase taxes, and you can do it in different ways. And that's a political decision. But essentially, that's what you have to do. And there's no, I mean, there's some grandstanding, but then we've got campaigns and they're talking about cutting. Both sides are cutting taxes. It's like, okay, that they don't get it. And yeah, so I'm very disconcerted of that. I mean, this is a huge issue and it's not being addressed, and it's not even on the table to be addressed. And I would like for one of the candidates to come out and say, look, we've got a problem, and this is how we address this problem. We're going to hike taxes here, and we're going to cut spending there. And that's my plan. And if you like that plan, vote for me. But they're not doing it. They're buying votes, and both of them. And so I don't think there's any right now. There's no hope to get this fiscal situation under control. And so my theory is that inflation will be used to take care of that. And in a way, inflation is maybe the fairest thing, because it impacts the billionaires just as much as the little people because their assets are deflating too. So, purchasing power, their assets are coming down too. And stocks, bonds, housing, everything loses purchasing power when there's inflation. So, the corporate leverage issue is more complicated because financialization is very uh, it's very complex all throughout the economy. You've got these cross webs of connections and borrowing and lending and relending and so there can be a lot of contagion. And when this corporate leverage starts going bad, you can have a financial crisis because a lot of the lenders are involved in it, and that can get really, really, really bad. So high interest rates will wring some of that out over time. So if they're high enough for long enough, I think corporate leverage will come down. And some of it will come down because companies file for bankruptcy because they can't refinance their debt. And then the debt will go away or partially go away. And others will try to restructure their debt without bankruptcy. We're seeing that. So they're already doing it, so they're already lowering the debt levels by restructuring, meaning lenders are losing part of their investment in these loans. And that's how that needs to happen. Bankruptcy is a good thing because it takes that leverage off the corporate sector. And so hopefully this happens slow enough and over the years so that everybody can deal with it without a big blow up. And
If
and
it
that
doesn't, if it doesn't, what does it look like?
well, it's bad. If it doesn't, it's bad.
2008 style
Yeah,
contagion?
I mean that's when leverage blows up, it's bad. Um, so if you have enough inflation and we have enough time to unwind some of this leverage, we won't get a big blow up, but we could get one, and then it's bad. And it's just like 2008. It's just similar. Except I
Okay.
don't think this time it'll be the banks as much. Back then, the banks were much more involved in it. Now the banks are still involved, but not to that extent. Now it's investors, institutional investors like life insurers and bond funds and hedge funds and all these others. And
It's the
all the
shadow banking system. Yeah, it's the
shadow
non-bank
banking
lenders.
system.
Yeah.
Yeah, and most of our mortgage debt is not guaranteed by the government, so that wasn't the case in 2008. So the taxpayer is gonna have to eat that one, and so it's going to be different than last time. But uh, when leverage blows up like that and there's contagion, it's just bad.
Right. And one might be able to argue that contagion is harder to contain in the shadow banking non-bank system because it's not as regulated. It doesn't, it's bigger, it's more amorphous, it's less transparent. The banking system at least is regulated. It's a finite number of banks. Fed knows who to interact with, right? A little bit different in the non-banking system.
Yeah, and I'm afraid of that. In that they discover that actually they have to bail out the shadow banks.
Yeah.
That'll be the next step. And I will be furious when that happens, and I will write furious articles about that.
Yeah.
And
And
this
I'm
that
not,
needs.
yeah, I'm just not sure culturally. I mean, we can have a debate over what are the options, but like, when it came out after 2008, that like, hey, we hate to bail these banks out, but it's the right thing to do if we want to keep things going. So many Americans are so still just red hot angry about that. I'm not sure if we've got another one of those in us.
Yeah, and we saw a little bit of that in March 2023 when we had these banks collapse, the regional banks, Silicon Valley Bank, First Republic, uh, and what they did is they didn't bail out the banks. So the investors went to heck, and the
Well, not in
lenders.
Silicon Valley Bank, the way that many would have liked, but
Well, so the depositors were bailed out.
yeah, yes, the
So
default, yeah,
that's different. So the investors, so the stockholders, the bondholders,
you're
they got
right.
nothing. During the financial crisis, they bailed out the stockholders and bondholders.
Yeah, yeah. Oh, sorry,
And
it's a
and then
correct
as a
distinction.
secondary result, the depositors stop worrying about it. And in this case, we switched to bailing out depositors. So depositors already have insurance, but we're talking about the uninsured depositors. And so these are in Silicon Valley Bank, these are billionaires and well-funded startup companies that had lots of money there, and they got bailed out because they were depositors. And but that's a much lower level of offensiveness than bailing out stockholders and bondholders in a bank, and
Agreed. Agreed.
bailing out the executives and that kind
Right.
of stuff. And
Still makes you angry, but I agree. It's not
yeah,
it's not the
yeah.
same level. Yeah.
So maybe they've got the message that you just can't bail out the executive team and let them have record bonuses after they blow up the bank. And
Yeah, which is what 2009 was, right? Wall Street
yeah,
paid itself record bonuses that year. Okay, look, fascinating, and so many other questions I had for you we're just not going to be able to get into. But let me try to land the plane here, and bring it to the so what level. Okay, so I'm a individual investor. I've just watched this hour and 10 long discussion here with you, Wolf. Definitely very nuanced things to be concerned about, but in many ways, things that are just not worrying you right now based on the data. That said, you started off by saying that you thought markets were precarious levels of overvaluation. So given your outlook and the way you see the landscape, what either investing strategies or even particular asset classes do you think are prudent to consider given the current conditions?
yeah. So for small scale investors like us, as they're not billionaires, um, my new rule of thumb is T-bill and chill.
T-bill and chill. Yeah.
And I don't like any of the stuff out there. Uh, it's T-bills are making 5% plus, or similar instruments, money market funds, little riskier, CDs, that kind of stuff. Uh, if you're a property developer and you know what you're doing, there's another opportunity there, and that is you can pick up some properties
Yeah.
at 60 cents or off, or 70 cents off for essentially for land value. And but you have to be able to redevelop the property, and we
Right.
see that it's happening, and it's a good thing. And
You live in San Francisco, Wolf, and like, yeah, there's some, some phenomenal locations that you can buy for a song right now.
well, it's still not a song, but it's still outside of my reach. But the thing is, you buy an office tower for land value, and if you want to convert it, you're going to be spending hundreds of millions of dollars to do that. It's very tough. And if you want to tear it down, that's also very expensive because you got office towers right next to it, and you got to tear it down floor by floor, and you're going to spend lots of money, and it takes lots of time. So the purchasing cost is going to be the most minuscule part of your investment when you do this kind of stuff. And the big costs come afterwards, what you do to redevelop it. And that's why I'm saying, these are pros that get into that, hopefully, and hopefully they know what they're doing, or else we're going to get even bigger problems. And we see it takes years, yeah. So, but we see some of that happening, and so if for people that are into that, I think there is an opportunity. People with lots of money, with lots of cash, we see it's hard to borrow, so you got to have the cash sitting there to do the redevelopment. And I think that's an opportunity there for some movement.
Okay, so basically what I hear from you is unless you're a deep-pocketed experienced property developer, your general advice is, hey, this is a time for defense. Just like don't even play the game. Just sit on the sidelines, collect your 5% in the safest of assets, wait for this precarious level of overvaluation to correct at some point, and then be in a position to redeploy.
Right, right. And also when markets go down hard, that's when cash evaporates. And because people are leveraged, and they have
Sell
margin
everything.
calls.
Yeah.
Yeah. And so you'll be the only one left with cash and buy stuff. And it doesn't have to be stocks, it can be anything. So now liquidity, when it vanishes, that's a very tough thing. And when you have liquidity, you can get good deals.
Okay, so it sounds like you feel the probability of a cash is king moment is high enough where T-bill and chill approach,
Yeah.
is appealing to you.
Yeah. Yeah.
Yeah. Okay. All right. Well, look, Wolf, thank you. This has been wonderful. I get calls on this channel, to bring on more bullish people. So many of the people you have on are so bearish. And look, I don't know, and this is a great example. Like, I don't know what the experts I bring on are going to say in any given interview, right? So it's not like I'm filtering for some sort of philosophical angle on behalf of the guests. I just like people that take a data-driven approach and can defend their positions with data. And you were a great example of that. And I wouldn't call you a raging bull by any stretch, Wolf. But I think you've done a very, heroic job here of saying, hey, it's not as bad, at least looking at the current data, as a lot of people, a lot of recessionistas, think it is right now. And until the data changes, you're not going to change that outlook. But I do get the sense, Wolf, that the minute you potentially got data that conflicted with your current view, you would change because the data is changing.
Yeah. Been looking for it for 2 years.
All right. Well, let me just extend first my thanks for just playing the role of exactly what I wanted you to play, which is just kind of Vulcan. Hey, forget about emotions. This is what the data is saying. But also extend an open invitation here that if and when your data set changes materially in one direction or the other, such that you're changing kind of your base level expectations, please come on the channel here and explain why to all these viewers. For folks that have really enjoyed this discussion, and again, the objectiveness and the analytics that you bring, where can they go to follow you and your work?
wolfstreet.com. Everything is free: business, finance, and money. We don't do politics, and we have a vibrant and fairly well-behaved commenting section.
Okay, fairly well-behaved comment section. No, Wolf Street is phenomenal, as I mentioned at the beginning of this video. If you haven't read Wolf's material before, he is very respected for his analysis, but he's kind of renowned for the charts that he produces. And I'm sure if you see the charts, even the formatting, you'll be like, oh, I've seen those charts before all around the internet. So definitely go check out wolfstreet.com. If you would like to encourage Wolf to come back on this program anytime his model materially changes, please let him know by hitting the like button, then clicking on the red subscribe button, as well as that little bell icon, like I mentioned at the beginning of this video. Make sure the bell icon's clicked, and then make sure your device is set to receive notifications from YouTube. Look, if you are finding yourself challenged to look ahead and say, gosh, how do I shepherd my wealth through, all the cross currents that we've been talking about here, as well as if Wolf's concerns about some sort of liquidity reckoning happening, how do I make sure I'm just not collateral damage to that? Highly recommend that you follow the guidance of a professional financial advisor who takes into account all the macro issues that Wolf has been highlighting here for us. It's kind of a tall order, not that many do. But if you've got a good one who's doing that for you and then executing a personalized plan for you, great, you should stick with them. If you don't, you'd like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the guys you see on this channel with me week after week. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. These consultations are totally free. There's no commitment to work with them. It's just a public service these guys offer. And lastly, if you haven't already bought your ticket for the Thoughtful Money October online conference, please do so now, because we're still offering the lowest early bird discount price. And I want to make sure as many people as possible who are planning on attending the conference get that lowest price. And a reminder that if you are on top of that, a premium subscriber to our Substack, you'll save $50 off the ticket price. And just a reminder, our Substack only costs $15 a month. So pay $15, buy the conference ticket, which you save $50. So you're really pocketing $35. If you want to game the system that way, I'm totally happy if you do. And just a reminder, the lineup for the conference is phenomenal. Lacey Hunt will be the kickoff keynote. And if you've ever seen a previous conference with all the charts and data that he brings, as well as a lifetime of expertise as being a former senior Federal Reserve economist, people say that's worth the price of admission in and of itself. We'll also have Stephanie Pomboy there giving her macro outlook. We'll have Darius Dale giving the latest updates on what his incredibly detailed model is telling him. We'll have Michael Pinto there, who'll be giving his market outlook, as well as sharing what his model is telling him and how he is positioning his clients. We'll have former Fed official Thomas Honig here, phenomenal get for this year's video, or this year's conference. And instead of me, I've asked Danielle DiMartino Booth, former Federal Reserve advisor, to interview Dr. Honig. So that's going to be a fantastic discussion. We'll have Mike Leibowitz from RIA here giving us the latest update on bonds. He'll be followed by Stephen Bavaria, who will be giving us the latest update on building an income factory in your own personal portfolio. And he will be sharing specific tickers of a lot of the instruments that are currently on his radar that he's actively investing in right now from an income standpoint. We'll have Brent Johnson, father and creator of the dollar milkshake theory, giving us the outlook for the US dollar. He'll then be followed by Lynn Alden, who will be giving her thoughts on ways in which to protect against the loss of purchasing power of fiat currencies like the dollar and all the other major world fiat currencies. So she'll be talking about Bitcoin, precious metals, et cetera. She'll then be followed by Melody Wright talking about the housing market, and then followed by Rick Rule, who will be giving us his latest resource stock picks. And if you've ever been to a conference in the past, you know that Rick brings like close to 50 tickers. It's an embarrassment of riches of companies to go investigate. And of course, we'll also have our regular financial advisors available throughout the day. You can ask questions to guys from New Harbor, Lance Roberts from RAA, and Jonathan Wellham from Rocklink up in Canada. I also have space for one or two more surprises, which hopefully we'll be announcing on this channel as we get closer to the conference. But anyways, folks, so to go sign up for that conference, just go to thoughtfulmoney.com/conference. All right, Wolf, thanks for hanging with me through all that. Again, it's just always such a pleasure having you on. Really appreciate it and look forward to having you back on this channel as soon as your crystal ball tells you there's something important to notify folks about.
All right, thank you, Adam.
All right, everybody else, thanks so much for watching.